What's going on, guys? Welcome back, and in this video I'm going to be talking about gold, Bitcoin, and other stores of value and why those may or may not be a good asset class to be in for the next 10 years. A lot of this data is going to be coming off of the Federal Reserve, what Ray Dalio has recently said, and then also one of the investors' podcasts interviews that they just had recently where they really analyzed gold and other stores of value in the current economic environment. So if you guys are interested in ever figuring out, what is the data that you need to be looking at to figure out if you want to, say, be exposed to gold, Bitcoin, or other stores of value in your portfolio, make sure to stick around, hit that like button, hit the subscribe button, and without further ado, let's get in the video. So starting things off with gold, Ray Dalio came out recently with an article talking about how gold during the next major paramount shift that the economy is going to be going through, gold is going to be one of the asset classes that drastically outperforms. Now, the reason for this is that you have a very unique Federal Reserve type of situation currently. So if you've been looking at the Fed over the past few months, you've noticed that the Fed has been slowly trying to increase interest rates. I guess not really that slowly, but in the grand scheme of things, they're trying to take our interest rates from what were 0 and bring them back up to, say, about a 4.5 to a 5. That is generally what the Federal Reserve in the past has tried to focus at. They want interest rates, between 4 and 5%. That seems to be standard if you look at any economic textbook. And they want inflation to be at above a 2%, 2% to a little bit above a 2% roughly. In the past, we're just getting out of near 0 interest rates. Our inflation rate is, I believe, around a 1.6 or a 1.8. So none of these markers are really where the Fed wants it to be, while at the same time we are at, hitting all-time highs in the stock market. We are at, say, max employment because we are below the standard goal for unemployment rate in the United States. And so you'd think that on a surface level that we have an extremely strong economy. However, once the Federal Reserve started to slightly increase rates and once the China trade war started to really pick up again, the market went into a tizzy, and the market, declined multiple times over 10%. And everybody was essentially blaming the Fed because, okay, well, yeah, things were going great, but now that we have a possible trade war issue, companies are less profitable, and, you're starting to increase the amount of money it costs us to take out more debt to expand. What's going on? You want to blow up the economy. So recently, the chairman of the Fed, Jay Powell, started to talk about the ability that they might introduce of actually lowering interest rates in the near future if the market wasn't strong enough. If they didn't view that the market was, if they viewed the market was too weak to really go through increasing rates and also the trade war, they were going to start releasing the pressure on the interest rate hikes in order to really stimulate the economy again. Now, when you look at that, that is a big red flag, because when you think about it, you want interest rates to be going up when times are going good. Now, obviously, depending on the way you look at this, times aren't going great, but times are definitely not bad in the overall economy. So you would generally not want to have our interest rates sticking around, say, a 0%, like, 3 to 0%. You don't really want the interest rates there, because then if we hit a recession, there's usually no lever that the Fed can pull, like they say did in the Great Financial Crisis, to, drop rates down to 0 to really stimulate spending and push out more money and really stimulate economic growth again. So if we're in the environment where that lever is no longer going to be an option and the Fed's actually going to be starting to lower interest rates in the meantime because the market is essentially demanding it, and they say if you don't give us this, we're going for a recession because people are going to be pulling their money out, that's a really interesting spot for the Fed to be in. So the really only other option the Fed has, as a safety mechanism to, rejuvenate the economy if needed in the future is going to be to pump money into the system. Now, the reason why they would pump money into the system is because when you look at the debt levels across the United States, across end consumers, across businesses, and across college students, they're all at record highs and they're all, rapidly increasing. Our growth at this point in time, though, was starting to tip the scale in that it is no longer really profitable to, take on a lot of debt and really be able to service that debt while also being able to expand the business, let's say, in terms of a company. Say towards when you're getting out of a recession, a lot of companies that took on debt saw explosive returns because debt was essentially free because the interest rate was near 0. And, so all you had to do, you could take out $2 billion worth of debt as long as you could make, say, a 1% return on your debt Say if you can put $1 billion into something and get a 1% return as it, you will be making a massive amount of money, and companies just kept doing it, they kept doing it, they kept doing it, and now when you look across the S&P, the majority of companies are extremely debt burdened, especially when you look at like those really old companies, like say the consumer staples and everything that seems more of a safe company. Those companies over the past 10 years have been ballooning with debt in order to stimulate more growth, in order to drive their share price up for their shareholders. And that's something you can't directly blame companies for doing, but that's something that probably shouldn't have been their option. You don't really want a company, just because money is free, they take out a lot of debt and then they keep riding that up all the way until they realize that they are no longer getting a return on that. So if interest rates go up, companies can no longer take out $1 billion and then immediately be able to, net some profit off of it. Now it's getting to the point where they're taking on $1 billion, it's at break even, and we're at the top part of an economic cycle. So if the economic cycle starts to revert, and that debt burden maintains the same and our dollar remains the same, those companies will all start to implode because their debt payments are going to just eat away at all of their money until they essentially either go bankrupt or drastically downsize. So with the Fed possibly, seeing that issue and possibly wanting to avoid that issue, they're going to have to bring in a large amount of US dollars into the market in order to alleviate that debt burden. So Ray Dalio has actually talked about, seeing a devaluing of the US currency of up to 30% in the next couple of years. So what that would mean is that, there's an extra 30% of US dollars floating around, and now people are able to, use that extra cash that's in the system to pay off their debts that, essentially have weaker buying power, and then still buy the things that they want. So that way you kind of hit a point where, okay, we can still grow as long as we devalue our currency. And so that's going to allow, one, consumer spending to increase, and then two, also the debt burden to decrease. So essentially that's like the only way that the Federal Reserve can really keep a grasp on the economy and not have it derail and hit a recession, is if they start to introduce more money into the system. So if this happens, anything that is tied to the US dollar is going to have a massive shift in price. So that's why Ray Dalio and then a lot of other hedge funds are talking about why Bitcoin and gold could be really the outperforming assets you want to be in. Now, obviously, when you take a look at this, gold, Bitcoin, and other things like that don't have any value to them. Well, they don't have any intrinsic value to them. They have a speculative premium that people are willing to pay. It's tied to, say in gold's case, if you look at how gold fluctuates with the US dollar, generally as the dollar gets stronger, gold prices, flatten out and they decrease. And then the inverse is also true. Bitcoin, not to the same degree just because of how volatile Bitcoin is, but once Bitcoin becomes more and more, the norm, say, and that has a lot more liquidity into it, say like with the whole hedge fund market seeming to pump a lot of money into Bitcoin, that trend, in my opinion, is more likely going to be the same type of trend. People have always referred to Bitcoin as digital gold, and I do think that that is really the direction Bitcoin's going into. I don't see Bitcoin becoming a major currency, just because it is a currency, but it's not a great currency when you think about the volatility in it. But in terms of being a store of value, I do think that that is where everybody's going to be looking towards. So when you look at major commodities like this, and you are looking for a place that, okay, I want to park my money, but right now if I park my money in a savings account, my money is going to get eaten by inflation, because if inflation, say, rises and the US dollar, depreciates 30%, you essentially will have your money in your savings account, and then by the time that we're done pumping more money in the economy, you lose 30% buying power on all of the stuff that you've had in your bank account. And that's something not really anybody wants to do. The reason why you're saving that money is so that way you can use it for an emergency. But if your dollar is almost getting cut in half while sitting in a bank, when you're only yielding a, say, 1 to 2% interest rate on it, it's not really a good environment for people that are trying to save. So Ray Dalio was talking about how gold is something that you would want to have an exposure to in your portfolio, because as the dollar starts to decrease in value, your gold in retrospect will start to increase in value. Then you could possibly sell it and then buy other assets you think are going to be going on sale. Now, buying any of these things are more or less speculations based off of what type of environment you expect us to be going into, say, over the next, say, 5-10 years. In my opinion, I do think, so you guys know, in my channel's portfolio, and I just made a video about it, I'll link it to it here, that I do have a very small position in gold. With gold, I never want to have more than, say, 5% of my portfolio in gold. That's because gold is an active trading environment. Gold is something that you essentially assign it a percentage in your portfolio, and you're going to be buying and selling it accordingly whenever it goes above or goes below that, designated value, because there's really no cash flow you're receiving from gold. It's just how much are people willing to pay for gold today, and then how much are people willing to pay for gold tomorrow. And based off the economic environment you're in, that number is going to widely vary. So I do think that in terms of an inflation hedge, gold is one of the better options. As we can see here during the chart of, like, say, when we went through our last recession, gold did get a lot of money pumped into it, just because as the dollar started to devalue, when they started to print a lot of money to really bail everybody out of the major housing bubble, gold prices ballooned, but then they quickly reverted once the economy started to get back on its way. So it's definitely not going to be one of those things that gold is going to, in my opinion, that gold is going to drastically outperform for perpetuity. I think that it's essentially a timing play. And I know a lot of people don't like trying to time the economy, but it's a timing play that if you think we're due for, say, inflation, gold, Bitcoin, and other commodities like that are going to be the major asset play you want to be in. So that way you can essentially use that as your bank instead. As their price increases, prices across the board for other things tied to the dollar are going to decrease. And you can use that money and pump it into all that and buy a lot more of an asset, say, portfolio with, say, increased money. You get a return essentially on your cash to then go and buy other things with. You don't want to just, say, own the economy, own a commodity and then not sell the commodity. Generally, when commodities start to increase, you then want to sell them because there's going to be no cash flow again, and you're going to want to buy them when asset prices get devalued. So do I think that this is something that belongs in your portfolio? Well, obviously, I'm not a financial advisor, so I don't know. I don't know any of your portfolios, but I will say, if you do believe that we are heading for a, say, inflationary environment, gold is one of the asset classes that you might want to consider looking into. Now, you can also take, if you have a longer term time frame approach, in my opinion, I actually prefer more, pricing power strong stocks. So for example, sin stocks. Sin stocks are one of the best things to do in terms of inflationary environments than other stocks in the market, in my opinion. That's largely due to the fact that they have as much pricing power as they want on their product. Certain products, if inflation hits and it's a 30% inflation route, not a lot of people have the ability to just, increase, prices on the goods from, say, $100 to $130 overnight, and then essentially make the same amount of money as they did. When you have a sin stock and you have people that are only buying your particular product, they are in love with that particular product, you have a lot more pricing power, in my opinion. The same thing with, like, say, a Coca-Cola, same thing with a Pepsi, same thing with a Starbucks. Anything that, like, you have strong pricing power to your consumers in a good environment. In an inflationary environment, they're going to have an amazing pricing power to it, because to the end consumer's ways, they're like, oh, well, I keep getting raises at my job, because they're not paying attention to the inflation rate, so they're just going to be able to keep buying those products, whatever the price is. So sin stocks paying a massive dividend, being able to cycle in a lot more cash, their dividend is going to be able to probably grow faster than the rate of inflation, even in a more inflationary environment than we've seen in the past. I think that those types of companies will be, one, yielding you cash flow, the business will grow, and it's also an inflation hedge. So that's kind of where I would want to put more of my money, personally. But again, that's up to you. That's all up to the individual. You might not want to be exposed to sin stocks. You might not want to be exposed to companies that have a massive amount of pricing power just because of ethical reasons. And in that case, you might turn to a Bitcoin, to a Ethereum, to gold, to silver, to oil, anything like that. I'm also starting to look at oil rigs, because while I do think that oil is going to be in the decline over the long term, oil companies for right now are, where the world gets its energy. They all pay a lot of dividends. The larger ones do have a lot of oil reserves, so that way if the dollar gets devalued, essentially their inventory starts to spike in its value, and then those companies will start to, really appreciate in value based off that. Those are all kind of just different avenues I think you should be looking into if you do think we are headed for an inflationary environment. And if you guys want me to do a more detailed video on what really causes an inflationary environment, I will be more than happy to do that, but I wanted to get this out there because so many people are talking about gold and Bitcoin and things like that. So I figured I could give a little bit of light to people that don't really focus on these markets, kind of what exactly is going on and why are people saying that gold is going to be an outperforming class when, history has shown that gold does not outperform the stock market. So that's just kind of what I wanted to do with this video. Hope you guys got some use out of this. Hopefully it was kind of entertaining for you guys. Hopefully you guys, enjoyed this type of content. Let me know in the comment section down below, and I will catch you guys in the next video. Peace.